Okay, good evening, everyone. My name is Ming. So I'm actually a full-time trader for past 7 years. I'm doing swing trading mostly, and I'm trade gold, commodities, forex, crypto, and also stocks. So today I will be represent USmart to share some knowledge with you all, and mostly for beginners. Yeah. So today I will talk about option strategies. So for past few weeks, I actually share about what is options. So for those who miss, maybe you all can look back to my sharing videos, or maybe can add me in the groups later, and, and maybe in the futures I will make the same class again. All right, so don't waste any time. Today I will be talking about how to deploy a long course. So today is more about like practical sessions for option trading. So we will learn how to buy a long options and how do we pick how do we pick a stocks to do a long strategies by using options. All right, next. So options can be used in any market conditions. We can make profit in either downtrend, sideways, or uptrend. So there's a lot of option strategies. All right, there's a lot of different types of option strategies, and today I will talk more on the basics one, which is long call, the basic long call. So there's few strategies out there, and then since this is the beginner class, in the futures I will slowly introduce these strategies and discuss with you all. So for now, for the time being, as this is the sharing sessions for beginners, I will talk about the easiest one and the most basic one, which is a bullish buy call, bullish call. All right. So in either uptrend, sideways, or downtrend, we actually can benefit in option trading. So don't worry, we will learn all this and just be patient with me. And first of all, I also thanks everyone who joined with me today. I hope you all learn something throughout these sharing sessions. So what is options? This is some summary about what is options. So in options, as the buyers have the right. What it means by as the buyers have the right? Actually, as the buyers have the right, it's either the buyers of call options or the buyers of the put options. They have the right for the buyers to buy or not to buy. For put is to sell or not to sell. All right. And then for the buyers, they actually had a limited risk. If you all still remember, for the past few weeks, I shared about what is call option and what is put options. Call options and actually is looking bullish towards a stock, right? So you pay a premium, and the maximum risk you will face is the max premium, the premium prices. And it's also same to the put buyers, where you are looking for the stock price to goes down. Then you profit it from the price decrease, and the maximum risk we will face is only the premium you paid. All right. So for the buyers in call options or put options, you all actually have a limited risk. All right. Not too hard. Next, I will talk about the sellers have the obligations in options. So we have buyers, we have call buyers and put buyers. At the same time, we buyers must buy from sellers. So for sellers, we have to for sellers is actually receive the premium from the buyers, and call sellers are obliged to sell. So if the call buyers want to buy, the call sellers must sell to the buyers. However, the difference between obligations and right is the right can choose to buy or not to buy. However, for obligations, the call sellers have to sell to the call buyer. For put buyers, they have the right to sell or not to sell. However, for the put sellers, they are obliged to buy to buy. So they cannot say that, oh, I don't want to buy. They must buy from the put buyers. All right. So sellers always face unlimited risk. What it means by unlimited risk? Means there's not a maximum risk that kept for the sellers, for the option sellers. So for those who don't understand until here, maybe you all can look back into past few weeks what I shared about what is call option and what is put options. So no worries, you all, for those who didn't join, and for those who still learn or still new in option trading, you all just understand that for the options, the buyers always have limited risk, while the sellers always had unlimited risk. You all just remember, just stick this to your mind. So for today, I actually just focus on call buyers. So for call buyers, we only have limited risk when we want to long a stock. We use option to long the stock. So we always have limited risk. It's a very basic long strategy, and the risk can be calculated easily as there is max losing risk. So we can manage our trade well. All right, by doing call long option strategy. All right, I think this is just a revision about what is options. There will be call buyers, put buyers, call sellers, and also put sellers. All right. So I will continue my slide next. Okay. So today I will talk about long strategy, long call. Like I said, we just learn the basic one, like from the point A to point B. When the options goes out from A to B, then how much we will earn, and then we can estimate how much can we earn. So we need to know how to make an entry, how to exit, and how to cut loss, risk management. So let us go through this long call strategy. So when do we deploy this strategy? All right. Obviously, we need market to be very bullish because we want to earn through the uptrend. Since we are doing long call, we want the stocks to go up. And then next, we expect the price to move sharply. So when the call options move sharply in a shorter time, we can actually make huge profit from options. And then we also looked at the low implied volatility, which I mentioned last week, which is one of the extrinsic value of options. So it will also cause the options to goes up either very fast or goes down very fast. The volatility will determine how much it can gain or how much interest in the stocks. So we have to monitor this. If the implied volatility is very high, usually the options premium is very expensive because many people will chase into it. So when to long a call strategy, we must avoid high implied volatility. We don't want to buy when everyone is chasing a stock. It's just like when a stock moves very fast towards trending upwards very fast sharply. So we don't want to chase over those very hot stock. We want to wait it comes down and then maybe consolidate and then got some bullish signal, then we only appear. All right. So we don't want to buy high implied volatility, high IV stocks. We want to buy low IV stocks, which is relative stable. We want the price go up, go down a lot. Then we also want to seek for a high risk, high rewards entry. What it means by high risk, high rewards? High risk, high rewards means like you maybe the premium you bought is around 100 and then you must target at least 1 to 2 and above. It means that when you lose 100, you can make 200. You must have the high risk reward reasons to enter the markets. So we need to pick a stock that have potentials that move very fast for your entry. So your cut loss maybe is 100 or 1%, and then you can earn 2% or 3% in one trade. So we don't want the risk reward is very low. It's because if the risk reward is very low, we could hardly profit from the markets. I explained the risk management, I think maybe last week. I talked about psychology, how to use technical analysis, and then maybe you all can look back. So all these are the basic stuff, but actually it needs times to master because trading actually requires strong discipline. Everyone's had different types of strategy, and today what I share is just my opinions about this market, how I trade. I just share part of my strategies because everyone's goals in trading and investing is different. All right. So y'all just go through with me, and maybe y'all can point out what is better to pick, and maybe what indicators y'all use, or maybe y'all got a better strategies. Maybe y'all can share below. All right. Today I just share what I will see, what information I will use in trading option by doing long call. All right. Next, I will also look at the optimal technical patterns. What it means by optical technical patterns. So in technical analysis, there is different types of chart pattern, right? So I stick to certain with high winning rates technical patterns. And then when there is a signal happens, I will enter it based on my strategies. All right. So next, we also want to enter a stock, a stock with high momentum. Why high momentum? High momentum actually means that there is interest, there is volume in the market. So the stock price can move fast. In long call, in options, we actually wanted the stock price to move very fast in a shorter time towards our target price. Why? Because there is an expiry date. So we don't want the market like no momentum and then it keeps sideways. Then until the expiry date, you will lose this trade. So high momentum stock is preferable. And I also looked at when the price breaking out from consolidations. So consolidations is one of the technical analysis that most of the people use. When a stock keeps sideways in a certain range, and then suddenly break out the sideways, then we and then retested the resistance, then we can consider to enter. So all this is based on my technical analysis pattern. Sometimes it cannot fulfill all this, but we try our best to find the best quality stocks to trade as we want a high winning rate trade. So if all these factors and more factors is appearing, like the signals appeared, so we can say that the confluence is very high. Then our chances to profit in the market is increasing. And we also looked at when the price bouncing off the support. So we know that for the technical analysis, there is support and resistance, right? So we long at the support and we also sell at the resistance. So all these are the basic technical analysis. I will go through all these technical analysis in my others sharing sessions. So I will mainly focus on the option strategy for the beginners, and then also maybe trading, how to become a technical trader, mostly on technical, how to become a trader, how to become a profitable trader. And I also talk about automated strategy, which is grid trading. So for those who are interested, you all can follow me or maybe add me later. So in futures, I will share more about this in my groups. All right. So this is how I pick how I pick a long call stocks. I will, I will monitor all these technical reasons. So for the common ones, we use MA strategy. So what is MA strategy? MA strategy actually is a moving strategy. I'm sure that if you all learn about technical analysis, this is the most common basic one. MA is a moving average. Maybe MA 14 days is like the 2 weeks average price of the stocks. So if the 2 weeks average price of the stock is sloping up, it means that the market in these 2 weeks the price is getting higher and higher on average. So by using these MA strategies, we actually can monitor the trend of the markets. All right. Next, I will show some examples that I pick. Okay, so I think here everyone knows what is NVIDIA, right? NVIDIA is I think considered a very hot stock this year because of AI related theme. So in this case, I actually print screen NVIDIA's, I think last few days ago. This chart is few days ago. So you can see there's 4 lines. I'm using EMA, which is exponential moving average, is slightly more sensitive towards normal moving average. So the most thin MA is 14, and then 20, and then 50, and then 200. So in this case, you can see the 14 is crossing up the blue line, the red line is crossing up the blue line, which is 14 is crossing up the 20. So it means that in 14 days and 20 days, the price is actually moving forwards, moving upwards. So we wait until it retraces to the average price, then we enter the long call. This is one of the examples we enter the markets by using MA strategy. So another one, the most common one people use is using support and resistance strategy. So they look at the strong support and also strong resistance, then they plot it, and then they try to buy at the support and sell at the resistance. So if the resistance break through, we will wait that it retested back to the resistance, and then hopefully the resistance will become a support, and then when there is a buying signal again, then we will enter it again. All right, so from here we can see that the NVIDIA previously it has two tops there before it breaks up, right? The bottom one. So if it finally breaks out the strong resistance, then we can consider long there. And then it goes up, and then it forms a certain kind of resistance there. And then it actually retested back to the previous resistance. And then it's confirmed that, and then when it retested, it formed a bullish candle. Then it trending up again. So in this case, we actually got two long potential long call entry. All right. So remember, in basic support resistance, actually we just look at the naked chart. We don't use any indicators. We just look at the break and retest strategy. We usually don't long on breakout. Why? Because breakout sometimes can, in markets, it got a lot of traps. Sometimes when you long on breakout, it can be a fake out. So when you long, then it suddenly reverse all the way down. So it's the best we wait it to break all the way up and then retest the previous resistance, and then we only make an entry. So by doing this, we actually need a lot of disciplines. By not forcing trades, we wait the trades to comes in. And it's actually very hard for normal people, including me. It takes us to master the psychology. So I mentioned why psychology is very important, I think, last week presentations. So you all can maybe look back at the slides. Trading is 80% about psychology and 20% about strategy. So we need to wait the best setup, best quality setup, and then we wait the price come to us, but not us chasing the price. We don't buy at high, we don't chase, we wait at the retracement, and then consolidation, and then some sort of bullish reversal sign, only we make a trade. Then we also plan risk management, and then there's a lot of stuff. So trading is actually a learning no ends field. Yeah, we need to keep on learning until we found the best strategy to suit us. So okay, talk a little bit more about technical analysis in futures. If you're interested, make sure you all let me know. Because in option strategy, once you know how to deploy the option strategy, we still need to have a good technical analysis to make the entry, to find a good entry in these long call strategies. There's other strategies that don't require actually such sharp entry, and we will talk about it in futures. So today I will just focus on this chart. So let's look back again, NVIDIA. So we can long call at this area. All right. So this is USmart. So for those who don't have USmart, maybe at the end of the presentations, you all can consider use my referral codes to download it. And USmart actually provides a best fees. I think it's better than others competitors. I think it's the cheapest now. So you all maybe can consider using this. All right. So this is USmart apps. And how do we trade options? How do we buy options? So when we go into interface, we pick a stock, let's say NVIDIA, and then you press the options, and then it will appear all these informations. So you can see in options, we actually look at the expiry date, right? So under the options, we choose one of the expiry dates. Normally, I will choose, I think, more than 1 month. It really depends on your strategy. Somebody's want a short trade, and then somebody maybe wants a swing trade. And sometimes some trade can be very long, from two weeks to 4 weeks, some from 1 month to 3 months, and even though some is more than half a year. So it really depends on your strategy. For me personally, I will just pick more than 1 month or around 2 months to be safe, because we are afraid that we are looking the markets to trend out, but maybe in 1 month's time, it can be sideways. So the longer the time, the higher the probability. However, if you choose a shorter expiry date, remember there is that time decay. So your premium will decrease very fast. Your option will decrease very fast, the value. All right. So to prevent the time decay, we actually it's much better to choose maybe more than 1 month and above. We don't want a short expiry date to avoid time decay, because time decay is at very fast during, I think, the last 30 days. We don't want that. So after we pick a expiry date, then we look down, there is a few informations about the strike price. We must look at the strike price. So here we choose 140 strike price. And there's above there, you can see first bid quantity and first ask quantity. So what is bid? Bid usually is a price you have to wait for. You have to wait for the seller to buy from you. You are the buyer. You are waiting for the price. And then for us, it's the sellers that the price that already there. You can just directly buy the price. You can just directly get the price. But if you want to queue lower, you have to wait. Like let's say here is 140, the bid is 11.2. You have to wait people sell to you at 11.2. However, for the ask, it is 11.35. So you can directly buy 11.35. All right. So this is the difference between bid and ask. In this case, I usually pick ask because we just guaranteed to get the price. Since we want to open it, it really depends on your preference. If you want to get the bid or you want to get the ask. All right. So other than the strike price, there's actually a lot of information like open interest, implied volatility, vega, rho, all these data, all these I mentioned in last week presentations, which is extrinsic value. So, but today I will just focus on the basic one. We look at the expiry date, we choose a strike price, we buy at ask price. So we choose call, and then we pick the 20th December 2024 expiry date in this case. Then we continue to press at the 140. All right. When you press the 140, it will appear the surface that show NVDA 24 12 20 20. It means by the expiry date. and the strike price is 140, and the C is call. So here actually it shows the mid price. Just now we said the ask price is 11.35, right? So this is somewhere between the bid and the ask price. So in this case, we just follow it, and then we press trade. After you press trade, we will see this surface with direction buy, limit orders, and then 11.35. Just now I said the ask price is 11.35. So we just directly buy it by pressing unlock to trade. I haven't in this case the app it haven't unlocked the trade yet. Usually when you unlock the trade, there will be a submit buttons. So when you press submit, then everything is done. Then you are successfully buy in a NVDA 20th December 2024 expiry date, strike price 140, call options. All right. So maybe you all can download the apps, and then you all try to use it, familiar with it. You all will understand what I'm saying just now by downloading the apps and then practice it on it. Okay, so it won't be very hard. But before we open the positions, make sure we know our plan. Because in trading world, when we open our positions, usually it's already decided that you earn or you lose. You can't do anything. You just let the time run. All right. So bear in mind, in trading, always make a plan. Always prepare well before we put in a trade. You have to know when to buy, when to sell, when to exit. And if the price goes up, you have to sell or not. If the price goes down, or any scenario, all this we must keep it in mind. All right. So this is how we put orders in Usmart by buying a long call. So based on the just now what we buy, the long call is one contract of NVDA at the strike price of 140, call options at the premium of 11.35. Usually in the app below, it will show how much your maximum risk to lose in this long call. So I will just roughly share with you all the risk reward profile of these call options profit portfolio. So we usually started to plot with the strike price, and then maximum is 11.35 times 100, the premium. So the maximum we paid, maximum risk equals to the premium we paid, which is 1135. So in this case, when we long the NVIDIA, maximum we can only lose 1135. So, and then to break even, you have to move beyond 151.35, which is the break even formula is strike price plus premium, because when we buy a long call, we already lose premium at first, then before we profit, right? So for the profit at expiration, let's say here I put it 200. When the NVIDIA can reach 200, we actually can profit around 4865. Here you can see we use stock price minus 140, then minus the strike, then minus the premium. So total we can, if this call options hits 200, we actually can earn around minimum 4,865. So why I say minimum? You all see the dotted lines that goes up very fast? It depends because other than intrinsic value, the minimum 4865 is the minimum value. For the dotted lines, actually there are other factors, extrinsic factors that will affect the market stock price. So the profit will be not affect the market stock price, will affect the option price. So the when the interest is very big, the delta is very high, the option price can actually move up very fast. So the extrinsic value is important in this, but as we trade the call option, at least we need to know the minimum and maximum risk we could face. So if the NVIDIA can go up even further before the expiry date, the profit is limit, the sky is limit. So we say unlimited returns. All right, so this is the examples of how we long a call using USmart. And then I will give another examples on how do we choose a stock and how do we trade it. All right, so this is the first examples. And next, I will show you another examples, which I find, this is what I found it, I think, QCOM. I'm not sure you all are familiar with this stock. Actually, it's one of the semiconductor stocks. So recently I found it that it had trend up and then trend downwards, and it trends towards the supports. Recently it's forming a consolidations around the supports. So here it still don't have a strong bullish candle. So it's not the best time to get in, but I just take it as examples and potential. I'm actually just monitor this stock and I take it as an example as it is on the support area, especially the strong support area. So I pick this so to share with you all how I choose a stock before it move. We'll just wait, draw a certain zones, support resistance zone, then we wait at the area to get a better price. All right, we did not chase high, we just wait the price come to us. Then we wait it form some maybe bullish candles or any bullish signal from technical aspect. Then we only go in by doing a long call. In this case, it is at the daily support. So I assume that there is a bullish signal comes out now. So I want to long this QCOM by using options. So currently the QCOM price is at 160.5. So the resistance is 230. So this is actually a big swing. So actually in real life, we actually want to take a longer expiry date if you want to swing such a long trade. All right, so I expect in this case, I expect it can move all the way up to 230. So if you look at this technical chart, so we must identify what setup is this. First, bullish setup. Since it's at support, right? Then QCOM is currently at 160.5. We want to know the current price, and then we find the best strike price in call options. So the strike price is better at the money or slightly below the slightly out of the money. All right. So in this case, since the QCOM price is like at 160.5, I want to buy one contract of QCOM at 20th December 2024, call at the premium of $7.1. So we want to long from 160.5 to 230. Then we buy one contract of QCOM 20th December 2024 expiry date with a strike price of 160, call at 7.1. So just now I showed that the apps platform, but now actually this one is USmart desktop platform. Y'all is still the same. Y'all just pick the US option and then you search for QCOM in this case, and then y'all can see the expiry date, and then y'all can see the strike price, and then y'all can see the ask price. So in this case, the premium ask price will be the premium, which is $7.1. All right, understand how we start to pick a stock, how we start to trade a stock and doing a long call by using USmart. So we exercise. So this is exercise I give you all, but I also will go through with you all. So just take it as an exercise. And in this case, we long QCOM at 20th December 2024 at 160 strike price, call options at $7.1. All right. So how much does it cost to buy one contract? So when we buy a call options, we want to know how much we need to spend, right? We need to know how much we can lose. So remember that when I said for the buyers, your risk is always the premium. Your maximum risk is always the premium. And then one contract is 100 share. So in this case, it's 7.1 times 100, which is 7 and 10. Next, what is your maximum risk? So are you all still following me? So can anyone state down what is the maximum risk in this case? If you all understand the call options, maybe y'all, I think this is not a no problem to y'all. Anyone can share their thoughts and maybe types in the chat box. All right, the maximum risk is the same with the premium. Right, we maximum risk as a buyers in options, maximum risk is only 7.1 times 100. It's also the $710. So what is your break-even point at expirations? So we will buy the strike price call option at 160. And what is the break-even price for us to start earning profits in options? We need to wait the stock price to move past premium, stock price plus 3 premium. Only we get the break-even stock price. So if you all have the answers, it will be 160 plus 7.1. The stock price have to must pass through 167.1 for us to be to start profiting. All right. And then we need to know if the QCOM price goes to 230 before expiration date, what is the minimum profit would you earn? So this one is very easy. 230 minus 160 strike price, then minus another 7.1 premium you paid, which is wait, 230 minus 160 minus 7.1, which is 62.9 times 100 shares, which is 6,290 shares. I hope you all like staying with me can practice this exercise and do this calculation together with me. So you all will have better understanding about what to expect in when you long these call options, what to expect, how much money you need to spend, how much capital you will lose, and how much you will earn, how much potential profit you will earn. And then for this, draw the risk to return graph showing the maximum risk. I think it really depends on you all. But if you all can draw it, it means that you all already mastered this option strategy. This you already understand the options very well. Call options very well. So these are the answers that I shared just now. So you all maybe can take a screenshot, or maybe when you all look back, you all can do an exercise. Then you look back to see whether the answer is correct or not. So this how the risk reward profile, profit loss profile looks like for the QCOM 20th December 2024. Strike price 160, call options at 7.1 premium price looks like. So in every long calls, we need to know how much we will lose, right? And then we need to expect how much we will earn. So if you risk, like your risk is like 1-to-1, maybe it's not good. It's not that you cannot trade like that. Maybe we want to at least find you risk 100 to earn 200. Like in this case, you want to risk like 700 in case you want to get a return, I think at least more than 1,400. So you can keep on stacking your wins throughout the time, and then you earn the profit consistently from the markets. If not, if your winning rate is very low, in the long time, you will burn out all your capitals. So we need to control our risk very well. Not more than 1% in each trade of your capitals. Let's say you have 10,000, you only can risk 100. All right. So these the calculations is like I mentioned just now. Is the same in NVIDIA. The strike price is 160, and you need to move past 167.1 to start profiting the stock price. So when it hit 230, our expected target area, you had a potential to earn 6,290 in this call option, at least. Okay. So I'm not sure it's too heavy for you all. I hope all this exercise can make you all more understand on how to long a call. So all this we must know in our mind before we start to trade. All right. Okay, I give maybe 1 second or two for you all to take a screenshot, and then you all can also look at the platform to find another examples, another stocks examples, and then you all try to answer yourself by doing all this exercise yourself. Then you all can understand well how the call option looks like. All right. So there's a lot of steps to long and options. It really depends of everyone's strategy. As I said, there's a lot of thousands or maybe more than thousands strategies outside there. And then everyone looks at different stuff. Some people like to trade a high IV or high Vega, all different types of reasons they have. So for me, I'm old enough to not to chase those very fancy stock or very trending stocks. Even if I want to chase, I will wait it drops, like it do a bigger corrections and stay at the support for certain times, consolidate, and then some bullish reversals signal, and then I only enter at that time. All right, usually when you chase a hot stock, if you didn't get out quickly, you will tend to get burnt. This is my experience. I'm not sure everyone is like this, but when I chase, I always get trapped at the high or at the low, anything. I just will get trapped. So I don't want to go through all this already. So it really depends on your ideas on the market. Short-term trade, invest, long-term trade, mid-term trade. It really depends. So I will state out what I look at before I do a long call strategy. So first, I will identify a bullish trade on a stock, whether it's fundamentally or technically. And then I will look for the IV percentile is below 40%. Unless sometimes I'm very confident on this stocks, like trending stocks, such as NVIDIA, all this is very high momentum and I got a lot of interest. Usually the IV won't be that low. Maybe around 50%, I will still get it. If I want to trade all these fancy or strong uptrend stock. And then to check the option chain. And then I choose the long expiry dates, like 60 days or more than 30 days, because the last 30 days, the time decay is the fastest. We don't want to lose the option price so fast. All right, so we'll choose the strike price with the value of 0.5 to 0.6 at the money, or one strike price in the money. It really depends on your strategy. So this is my preference. You all can just maybe take it as a reference and practice it and look what is good for your. Maybe you all can do paper trade if you're just journaling down. You all will buy at this, and then maybe you all can observe the price movement within the periods and keep on improvise your strategy. All right. So we choose contract, and then the premium should be less than 2%. It means that when you buy the premium, you can't risk less than 2% of your total capitals. So as a trader, I not advise people to trade more than 2% per trade, because if you risk more than 2% per trade, it actually is very risky already in terms of traders' view. However, this is still depends on everybody's preference. All right, I just share what I will look for, and yeah, hopefully you all can take as a reference. If anything you all that have doubt, you can let me know. All right, and then we also analyze the risk return profile, and then we place a limit in the order, either bid ask or mark price when the market is open. All right, so all this maybe looks very confusing for some of y'all, but this is how we learn to become a trader. People think that trader is very easy job. Actually, it's the hardest way to earn easiest money. Right? To be fair, it is not that easy and it requires massive amount of psychology. So there's a lot of technical stuff to learn, and most of the people, they want the fastest pace. They don't want to understand what it is. They just want to get the tips. And I advise it's not really good to choose that, but y'all can still feel free to choose those signal pick. But it's the best if you understand yourself. Then you all will have a better control of your psychology. And then if you know what you are doing, eventually you will earn in these markets. If you're panicking in buying or selling all around the stock markets, I think this is just a gambling mindset, which is not encouraged. However, just a piece of old man advice. So some people like very aggressive one. So it's no good or wrong, right? It's just a preference. So we also ensure the bid ask price options is not too much the gap. Like the bid, just now I said the bid and the ask price don't be too much. So how do we exit a long call? So if you know how to entry, but you don't know how to exit, it's also useless in the markets. So usually we sell the call when the stock has reached the price. Let's say just now the Q come, I in 230. Before the expiry date, if it hit, then we just sell it. We don't want to wait at the expiry date because the time there is time decay. All right. So and maybe some people don't want to sell it because it is already deep in the money, and it really depends on your strategy. And also, if you hit the intended risk reward, you must sell it because this is your plan. Like you risk 100, you want to earn 300. When you reach the price, somebody will like, oh, I already earned 300. I don't want to sell it. I want to wait for 500. So you're already breaking the rules of your price, of your plan, trade plan, which is no good because you don't have discipline. And then if you keep switching your targets, eventually in the long run, you'll have a hard time like getting a consistent return because every trade you can't really gauge the range, the profit range. You can suddenly win big and suddenly lose big also. So as I always mention, I always buy the longer expiry dates so to avoid the fast time decays. So sometimes things goes wrong, right? When we look at the markets, we want to buy, we are bullish, but sometimes the market structures can suddenly change. So when there is a sell signals after we long a call, maybe we can consider to cut losses. Either the stock has reached the price, this one, this, so we can sell the call option at loss when the option loses 50% of its value. Actually, it depends because, like I said, for me, I will risk 2%. When it goes wrong, it drops more than 50%, which is 1%. I might consider gets out of the trade because usually when it is right track, it won't retrace down. But this is my preference. Sometimes it retraces down, it goes up. So it really depends. And the option reached 30 days before the expirations. So I will sell it and then maybe I will buy another longer expiry date because I don't want to face the time decay. And then the stock price no longer have bullish uptrend, technical reasons or fundamental reasons, any reasons. So you must have your own strategy, either technical fundamentals. I think technicals alone, there's a lot of strategies already. So we have to find one suit you the most and then you stick to it and then you get the win rate statistic, then only you start to trade the markets. If not, you're just gambling it by jumping it. All right. So this is the presentations I shared today. I hope you all learned something. And if you've got any questions, feel free to list it down in the chat box and I will try my best to answer. And thanks for coming to hear my beginners sharing. All right. If no one, so y'all can consider to use my UseSmart app. For the left side is for the Hong Kong users, and then for the right side, for the middle one is for Singapore users. And you all can consider to use my referral codes and then add my WeCom. So I will leave it for around maybe 30 seconds. And then anyone have got any questions? And this is my Telegram group. So far, I don't have any members yet. Maybe you all can consider to add me. So I will share more insights about trading in the group in futures. So I welcome everyone and hope you all learn something today. And if I got anything talked wrong, maybe you all can let me know. we all learn together. And I hope you all get an idea on how to long call using USmart app. And thanks for the support and have a nice day. All right. So before I end, I'll just share the disclaimer. So I just share based on experience, and this is not any buy course or anything. And yeah, have a great day, everyone. See you again soon. Bye.